This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone, welcome back to the channel. With the recent market recovery, I'm curious. Have your accounts been hitting new highs? Mine recently reached an all-time high, but looking at my current portfolio allocation, I've actually gone through a massive shift since the start of this year. I've gradually transitioned into a yield-focused account. This is largely due to my current situation. After all, I'm now relying on distribution to cover my living expenses. Because of that, my portfolio is packed with funds that offer high payouts, even if their overall performance isn't necessarily the best in the market. I often wonder, if I had a larger principal to start with, would my allocation look different? In today's video, we're going to talk about the funds that, in hindsight, really proved me wrong. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US, and those distributions are paid out in USD. For those of you who need to bring that money back into CAD to cover daily expenses or pay bills here in Canada, this 0% FX fee policy is a huge advantage. It allows you to convert your distributions much more efficiently, ensuring that more of your hard-earned money stays in your pocket rather than being eaten up by transaction costs. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Moomoo is excellent. You can find a crystal-clear breakdown of geographic distribution and holdings, and even the dividend history and projections are laid out very clearly. For anyone trying to map out their monthly passive income, having that data organized like a digital pay stub is a massive time saver. Whether you're looking to minimize conversion costs or you just need deeper data to balance household expenses with portfolio growth, Moomoo offers a very practical set of tools. If you're looking for a more efficient way to manage your income portfolio, Moomoo is definitely a choice worth looking into. Actually, I recognized how excellent HDIV was early on. In fact, it was in my very first portfolio. The reason I didn't go heavy on it or why I chose other funds later wasn't because I misjudged it. It was a very real-life trade-off. Being currently between jobs and caring for a newborn daughter, my household expenses are a cold, hard reality. During a stage where I need distribution to pay the bills, an 11% yield is decent, but when faced with funds offering even more aggressive payouts, I chose what worked best for my immediate survival. But when you really break down the logic behind HDIV, it's surprisingly well-balanced. According to data as of March 31, 2026, its sector allocation is incredibly balanced. The core is financials at 34.2%, followed by energy at 16.3% and gold at 14.7%. These two latter sectors have provided massive cash flow support and a defensive cushion in the current market. Add in 13% in utilities and 12.7% in tech, and you have a fund that is rooted in Canada but still retains a sharp edge for growth. If you compare this to the TSX 60, while financials and energy dominate both, the other weightings differ significantly. For example, HDIV has a much higher tech weight, invested in US companies, and it holds gold, whereas the TSX 60 tilts toward materials. So, what impact does Hamilton's secret sauce have on performance? Well, from July 2021 to April 2026, HDIV's total return with DRIP reached a staggering 119.36%. For comparison, during that same period, VFV, the Vanguard S&P 500 returned 88.17%. VSP, which is S&P 500 with currency hedged, was at 62.8%. XIU, which tracks TSX 60, was 88.01%, and XEQT was 73.78%. Based on the numbers alone, it has been the undisputed long-distance champion of the last few years. As the flagship of Hamilton's income lineup, HDIV has been evolving by incorporating Hamilton's newer, specialized funds. Looking back, I feel a genuine sense of regret for letting go of HDIV due to my initial concerns over active management and the fact that the yield just wasn't high enough at the time. Since I mentioned HDIV, I have to talk about HYLD. As the other core pillar of Hamilton's income suite, HYLD has also been evolving by pulling in new funds like SCHD and CDAY. This track record since launch has been genuinely impressive. I previously ran backtests on HYLD and had a nagging concern. I felt like Hamilton was intentionally throttling the performance of SMAX and QMAX to make HYLD's overall trajectory mirror the S&P 500 as closely as possible. At the time, I was wary of that level of active management risk. It felt like there were too many moving parts being manually tweaked. Combined with my urgent need for higher distribution to cover life expenses, I decided to trim my HYLD position and eventually pulled the trigger on a full swap into the higher-yielding SCHD and CDAY. Looking back now, HYLD's performance remains stellar. The Hamilton team has proven their genius in stock selection and management. Even today, while my old backtest results still make me hesitant to make HYLD a massive overweight position, I've realized that a 10% to 15% allocation is perfectly reasonable and acceptable. Sometimes, because we're weighing risks and making life choices, we miss out on exceptional performers. That doesn't mean the decision was wrong. It just means our priorities were different at that stage. I hope that as my portfolio continues to optimize, I'll find an opportunity to buy back into HYLD. This also reminds me of a comparison video I did on utilities ETFs, where I narrowed it down to UTES and HUTE. Logically, their focus is completely different. UTES is concentrated on the top 10 Canadian utility giants, while HUTE holds 30 of the best global utility companies. To be honest, I still believe globally diversified, defensive profile of HUTE is superior. The latest market data backs this up. Over the past year, April 2025 to April 2026, total return of HUTE was 21.87%, while UTES was 18.5%. The gap isn't massive, but the curve of HUTE is undeniably smoother and more upward trending. But back then, I chose UTES. The reason was the same one I keep coming back to, the yield. If you look at the latest dividend data, the forward yield of HUTE is around 9.58%, while UTES sits at a whopping 18.12%. For someone who desperately needed cash flow to sustain living expenses, that 18.12% yield was simply too tempting to ignore. This is exactly what I mean by life trade-offs. If I had more capital or less financial pressure, I almost certainly would have chosen HUTE for the more robust global allocation and higher total return. But in reality, every single dollar mattered for my family's budget. While I technically lost about 3% in total return by chasing the higher yield, I don't regret it. Investing isn't a backtest in a lab. It's a tool for living. In that chapter of my life, UTES solved my immediate cash flow crisis, and that was its true value. Now, with my account at a new high, I'm reevaluating whether it's time to bring superior defense of HUTE back into the fold. Finally, let's talk about ECHI. I did a video on comparison between HHIC, ECHI, and CANI. After that analysis, I knew deep down that ECHI was probably the best fit for my portfolio's core. Yet, I ended up choosing CDAY as my defensive play. I made that call because I liked CDAY's underlying logic. Its base asset CMVP is an index, and Hamilton's BMAX series looked very promising at the time. A fund based on a dividend growth index felt like a safer defensive bet. But the data doesn't lie. Look at the total return comparison from August 2025 to April 2026. CDAY didn't do badly. As a defensive play, it delivered a 20.54% total return and definitely helped stabilize my account. But compared to ECHI, the fund I liked but didn't commit to, the difference is clear. ECHI returned 34.76% in that same period. This means that while I bought myself a sense of psychological security with CDAY, I missed out on a much more explosive growth phase. Looking back, ECHI's performance is far more attractive. It's been a point of reflection for me. Sometimes we chase a single attribute like defensiveness or index-based floors so hard that we lose sight of the better growth vehicles. CDAY did its job, but it pales in comparison to a 34.76% gain. This is a nuance I'll be taking very seriously as I continue to fine-tune my allocation. By now, you can probably see the common thread here: the ongoing tug-of-war between total return and cash flow. As a data-driven guy who loves running backtests, I know how important total return is. But when faced with real-life bills, sometimes the numbers have to take a backseat to survival. Seeing HDIV's 119.36% return or ECHI's explosive growth, I'd be lying if I said I wasn't a bit envious. But I don't regret choosing UTES or CDAY for the higher yield at the time. After all, the ultimate goal of investing isn't to have a perfect-looking backtest curve. It's to sustain our lives. These life trade-offs are an essential part of the journey. My account reaching a new high gives me a chance to re-examine and recalibrate. And that's what I want to share with you. There is no perfect answer in investing, only the configuration that fits your current circumstances. If you're in the wealth accumulation phase, go for the total return. Funds like HDIV and HUTE are incredibly attractive. But if you're like me and need sustenance to handle family expenses, then making a temporary trade-off is its own kind of compromise. I'd love to hear from you in the comments. Over this past year of market movement, which fund has humbled you? Or, for the sake of immediate cash flow, what potential returns have you had to sacrifice? Let's chat below. If you found today's deep dive and personal reflection helpful, don't forget to like, subscribe, and hit that notification bell. I'm Oldfish, and I'll see you in the next video.